Hello and welcome to Stockwatch Live. Now, restaurants, especially mid-range high street brands, have largely suffered the same setbacks of late as retail chains. We've seen a number of casualties, with Byron Burger and Jamie's Italian closing over a third of their restaurants in 2018. Italian chain Prezzo shutting 93 of its restaurants, and Zizi, Polpo and Café Rouge all due to close half their current sites. And only earlier this month, Pizza Express was found to be struggling with debt problems, sparking concerns that it could be the next high street chain to face a radical rethink or see its brand in jeopardy. One section of the casual dining market, though, that seems to have it just right was pizza delivery chain Domino's. With the World Cup fueling demand for quick and easy in-home dining, and as football fans flock to sofas nationwide with beer and pizza on tap, a stronger than expected performance came in from the UK and Ireland. However, while that was good news, it quickly turned out that Domino's appetite for global expansion was weighing heavily. Posting a near 10% fall in first half profits, it became evident that the company's international expansion plans were responsible for a big helping of the losses. In October, Domino's said over the 13 weeks to the 30th of September, UK sales were up 6%, driven by a near 11.5% jump in online sales, which made up more than 78% of total sales in the quarter. But that third quarter performance marked a decline from the first half of the year, when total sales rose almost 13%. The company said it would open 60 stores in Britain this year, which suggested it had returned its attention to the UK business. When it posts fourth quarter results on Tuesday, shareholders will want to know what's on the menu going forwards and whether the group has figured out a way to replicate, or maybe even ditch plans to roll out, its hugely cash-generative core UK franchise model to the rest of the world. Brokers can see some upside. Berenberg still rates the shares a hold and has cut its price target from 280 to 250 pence, while UBS has upgraded its investment rating on Domino's from sell to neutral, but cut its price target 5 pence to 245 pence. Now, talking of overseas business not going so well, personal care and consumer goods giant PZ Cussons will be giving an update on its first half trading on Tuesday as well. The maker of Imperial Leather Soap and Saint-Tropez tanning products said trading in Nigeria, which is currently weak due to the uncertain economic situation, would determine the performance of the business going forwards. Currency weakness is part of the problem in Nigeria, with the Naira down 15% against the US dollar in the first half. But the companies also noted that consumer disposable income has remained weak there ahead of the general election this February. As a result, first half profits from the country will be down year on year. The UK, it said, has been bucking the downward consumer trend, with the UK washing and bathing division experiencing good growth across key brands such as Imperial Leather and Carex, on the back of product launches and increased brand investment. And the beauty division has also seen growth across the portfolio of Sanctuary, Saint-Tropez, Charles Worthington and Fudge brands, again boosted by new product launches and an expansion into new on- and offline channels. Australia and Indonesia have also been solid. However, there's no getting away from the issues affecting its African business, which Cussons says will be dependent on the macro environment in Nigeria for the rest of the year. It has in the past insisted it wouldn't be selling it though, so the best shareholders can probably hope for is a favourable outcome from next month's Nigerian election, which could see more money flow into the economy. Of course, though, a close call could have the opposite effect. Elsewhere, conditions are expected to remain challenging, with commodity costs and exchange rates still volatile, so a lot of things are still up in the air. Analysts at Investec expect pre-tax profits of £85 million in the year to May 2019, up from just over £80 million in 2018, giving earnings per share of 14.7 pence compared with 13.4 pence. JP Morgan Cazenove has reiterated its neutral rating and cut its price target from 250 to 240 pence. The shares are currently trading around 209 pence. Now, things are up in the air literally and figuratively at low-cost airline group Flybe. Latest is an improved bid for the airline group from Virgin-led consortium, which is now offering £2.8 million for the company. It had initially come in at £2.2 million after the UK airline put itself up for sale in November on hopes that a buyer could come to its financial rescue. Flybe has suffered from industry-wide headwinds such as higher fuel costs, currency fluctuations and significant uncertainties presented by Brexit, but also as a result of over-expanding too quickly. At its full-year results last year, it reported net debt of £59 million, which is equivalent to 63% of equity. However, shareholders were clearly expecting the bid from Connect Airways, the joint venture made up of Stobart Group, Virgin Atlantic and funds managed by Cyrus Capital Partners, to come in at more than a penny a share. And the shares in Flybe immediately took a nosedive. At a dramatic discount to the 16.4p price Flybe shares had closed at the day before the offer was announced, they fell almost 90%. Shareholders hoping for a bidding war for the airline are going to be disappointed. Management at Flybe have recommended that shareholders approve the offer, which will see Connect Airways become a regional carrier for the UK and Ireland and operate under the Virgin Atlantic brand. Flybe's third quarter results are scheduled to arrive on Wednesday, and the shares are currently trading at under 4p. Also in the week ahead, look out for results from Samsung, Rank Group, Shell and BT. And you'll find coverage of the companies as they report on the Markets and Insights section at fidelity.co.uk. That's all for me. Thanks for watching and see you next time.